Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. Now, regular listeners will know that I am a little bit of a gold bug, so it should be no particular surprise to you that we wanted to record an emergency pod on the recent surge in the price of gold. We are recording this conversation on Monday. The gold price has just gone over $2,900. The precious metal is enjoying a bit of a bump after President Donald Trump announced tariffs on U.S. steel and aluminium imports over the weekend, but it had been on the rise long before that. According to a report released last week by the World Gold Council, total annual global gold demand hit a new record high in 2024, and the biggest driver behind this, and I quote, strong, sustained central bank buying and growth in investment demand. In addition, concerns about geopolitical instability and the return of global inflation have left investors looking for a safe way to hedge their bets. Hence, gold is on the up. On today's show, we're going to dig into all of this with Jack Ryan, a reporter at Bloomberg News who covers mining and precious metals.
Hi, Merryn. Thanks for having me on.
Also joining me today is Charlie Morris, Chief Investment Officer at ByteTree, to discuss the role gold should play in your portfolio.
Hi, Merryn. Pleasure to be here. Thank you.
Okay, these podcasts are supposed to be reasonably short, but I feel like we've got quite a lot to cover, so we better get going. Let's start, if we can, with you, Jack. Well, you just run us through what you think is happening in the gold market today. What's happening with this price action?
Today, it's pushed over 2,900 for the first time ever. It's been on this kind of continuous rise really since the start of the new year. So it's up about, I think, just north of 10% through January, which is a pretty chunky increase, particularly for gold. Going back a bit further, it set a lot of records, new records last year. It pulled back a bit after the election of Donald Trump when the dollar rallied, and a more expensive dollar is not good for gold. It makes it more expensive for buyers in other currencies. It's since then risen over the last couple of weeks, and it's really ridden the wave of instability that's come from some of the tariff threats that Trump and his administration have kind of directed at some of their foes and also some of their friends, Mexico and Canada in particular. And so all of that instability creates a really attractive environment for gold. It's traditionally seen as a safe haven asset and as a way to hedge against risks to maybe your equities that you're holding or various different other parts of your portfolio. So that is kind of the fundamental driver that's been driving it higher in the last couple of weeks.
So it's finally fulfilling its role as effectively the everything hedge. Doesn't matter what's going wrong. Gold is the answer, be it inflation, be it geopolitical instability. And then we have this other driver that is a bit more long-term that we wrote about and talked about quite a lot last year, which is central bank buying. And the central bank buyers are going to be a lot more price insensitive than, say, an investment buyer, right? So that's the longer-term driver.
Yeah, I think that's a really interesting driver of the gold price. And really, that story really picks up after the invasion of Ukraine. And obviously there was sanctions and there was various measures and freezing of various Russian assets, and it became difficult for Russia to use dollars that they had because they'd been pushed out of the SWIFT banking communication system. And so as a result of that, a lot of reserve managers of central banks around the world looked at that situation and thought, maybe we should diversify further from dollar holdings and our foreign exchange holdings, because we hold, tens of billions, hundreds of billions of dollars. This may well be used as a weapon against us in the future. We don't know. And that kind of made gold appealing, because gold was somewhere you could go from dollars. So we know that prior to the Ukraine invasion, central banks were buying about 500 tons a year. Since then, they've been buying on average 1,000 tons a year. So they've doubled their pace of buying, and they're quite a consistent buyer, because unlike the kind of quite skittish hedge funds or various buyers who are looking for kind of short-term tactical gains, central banks tend to be looking for tend to have more strategic goals in mind, and therefore when they buy, they tend not to sell, or at least they tend not to sell for a long time.
Okay, thank you. Charlie, when you listen to that list that Jack and I have just gone through, is there anything else that you think is driving the price that we haven't mentioned?
I think you've got most of the main points there, but I would just add one more thing, Merryn, and that's I think the world's underweight gold. And what do I mean by that? If you go back 50 or 60 years to the early 70s, when gold had a formal role in the financial system, where it was pegged or fixed to the value of different currencies around the world. In 1971, things changed. And I think that's quite important, because before that, it had always had this formal role. And the reason for that was it was the original fintech, the original financial technology, where you could go around the world in a sailing ship or on a camel across the Silk Roads, and an ounce of gold was worth the same on one side of the world as it was on the other. And the whole fiat system came about as a result of telecommunications and computers in the 70s and so forth. Prior to that, you wouldn't have been able to have that. So I think it's very important that gold took its role as an alternative asset rather than a more formal asset after the 70s. There was a time when we had so much faith in the fiat money system that we didn't really need gold in the 80s and 90s, when there was quite a hard money environment with Thatcher and Reagan and people like that in charge. But then in 25 years ago, the non-OECD countries started to increase their reserves slowly, and then after the credit crisis more quickly. And as Jack Ryan, who I'm sitting next to, rightly says, after the Ukraine invasion, they started to really accelerate those purchases. And there's one more thing I'd mention before I hand it back, and that is in recent days we've heard rumours of Scott Bessent in the Treasury Secretary in the US and the Trump administration and this sort of thing, talking about revaluing gold and so forth. Now, this has been all over Twitter, so it must be true. But I think what's really important is the fact it's the first time a Western central bank has really mentioned gold since 1971. So we've had the non-OECD central banks talking about it since 2009 and buying it. The Western or the developed nations haven't touched it or talked about it, and maybe that's about to change.
Okay, I want to come back to so many things in that list that you've given us, so many things to pick up. But before I do that, there's one thing that I thought you would mention at the beginning that maybe I can ask Jack about, which is this story that's been on Bloomberg today about China allowing insurers to buy gold for the first time, and the many, many billions that will redirect into the market. There are 10 insurance companies are allowed to start buying gold for the first time. And this is new because up until now, the insurers have only been allowed to invest in things that offer them, and I quote, stable cash returns. So there's a new source of demand for gold, and that may be driving the price a little bit in the short term. Jack?
Yeah, well, I mean, it's a massive, massive pool of capital, Chinese insurers. So even that notional 1%, if this pilot scheme is expanded and continued, I mean, that could be a huge source of demand for gold. But China generally has been probably the world's most important buyer over recent decades. Gold is attractive, I know, to a lot of Chinese retail investors, because if you have a very volatile equity market and then say you go into a situation where your property market is under pressure and that becomes a less appealing investment, there's not many options to move your capital out of China or to essentially engage in capital flight. But buying gold is basically a way to do that, where you're essentially taking your money out of your own domestic financial system and then holding it in this separate asset. So because of that, gold has been in the past quite an attractive asset to a lot of Chinese retail buyers. And then on top of that, the Chinese central bank, the PBOC, has been a really significant buyer of gold. Less so in the last year. It took a 6-month pause where it was not declaring purchases. But it has been a very significant buyer over the last 10 years or so, and particularly recently.
Okay, interesting. So what we're really talking about is there a change in the way that people are looking at gold and talking about gold. So Charlie, I want to go back to what you were saying, that there was this period, the hard money period, when we felt we didn't need gold. And this goes to the famous time when Gordon Brown sold a large percentage of the UK's gold, or what now looks like a ridiculous price. But there was the sense that you didn't need anything to back up a fiat currency. But I think the extraordinary thing to many listeners who aren't necessarily Charlie, little gold bugs like you and me, would be to think, well, why is gold still money after all this time? Why is it that central banks have been holding gold at all? The Gordon Brown view that it's not necessary, that what is it? What's the point of it? Why is it money? That makes a lot of sense to a lot of people. And the idea that central banks should now be going out and filling their vaults with actual physical gold seems bizarre to a lot of people. Can you explain it a little more? Why is it that gold is still money in this sense?
I think that's a very, very good question. And in a formal sense, it isn't at all. And it's, it was deformalized in 1971. Now, during that hard money era that I referred to, I'm talking about, Europe, UK, Japan, and the United States and Canada and so forth. I'm not talking about the non-OECD countries, many of which had a currency crisis during that time. There was the Asia currency crisis. Turkey had hyperinflation, as did Brazil and Argentina and all these sorts of places. And so currencies in the emerging markets at that time were pretty horrendous. And but in the Western world, the whole fiat system seemed to work quite well. Let's not forget, in the 80s, we had sky-high double-digit interest rates, and inflation came down, and so we could cut those rates. And so there was a good runway from which to demonstrate the prowess of the fiat system. But it was only when we started toying with zero rates when it really started to go wrong, and accumulating all the debt and the uncertainty with it, and the successive bailouts from one crisis to another. And I think that this is the really interesting bit, I find, is that, as you rightly say, the European central banks were selling gold in the late 1990s. I think the final sale was done by the Bank of England, famously at Brown's Bottom at $255 an ounce. And as Jack was saying earlier, we're $2,900 an ounce today. What a return, more than the S&P 500 over the last 25 years. The original sort of, my gosh, $255 is far too low for the gold price. I think some smart family offices and private investors figured it out first. Then, as I say, it was some non-OECD central banks who basically wanted to protect themselves from inflation and so forth. And then it was the credit crisis and it moved on. Then the best bit about this whole thing is that no one in a jurisdiction like Basel or at some big investment bankers or central bankers conference, no one wrote down you should own gold or you should have 10% of your national reserves, central bank reserves in gold. They figured it out for themselves. So Qatar and Saudi Arabia and China and all these places just came to the same conclusion on their own, without anything written down, that it's not a bad idea to diversify more of their reserves, not pile into gold, not a leverage bet on gold, but just to increase the percentage of their reserves committed to gold. And I'll say one last thing, and that was, when Mark Carney, who's about to be the Prime Minister of Canada, as far as I can see, when he was the Governor of the Bank of England, he was asked why we still held gold at the Bank of England. And his answer was tradition. As if it was just some sort of toy or a trophy or an old painting on the wall. It's quite fun to have downstairs. And I think that that's now changing. And as I said, the Americans are just about to start talking about gold publicly for the first time since 1971. No one's ever talked about it apart from Gordon Brown pretending it was a good idea to sell gold in 1999 or 98 and diversify into euros.
I suppose if you change the word tradition for history, it makes more sense, doesn't it? Because what you've just been saying is that there isn't anything like gold, anything with the historical record of gold, anything with the global acceptance of gold. There's nothing you can replace it with. There's no currency that can be gold. And maybe that's what Mark Carney meant. Maybe what he was saying wasn't something quite as idiotic as you think, maybe as you say. Maybe he was just saying it's the only thing with a monetary history such that it has to be in every central bank's portfolio. Or am I being too kind?
Yeah,
am I being too kind?
Well, he said tradition, and I think tradition, what he meant was it was the sort of, he'd come in and just like the Bank of England has got rather nice paintings on walls and marble columns and things, I think he just associated it with that. It is a good question, but I would remind you that when we talk about gold, gold's not really a currency, it's an asset, it's a commodity, and that's really important. And it's also the most liquid alternative asset in the world. So alternative assets don't have cash flows. Yeah, companies have cash flows, bonds have cash flows, fiat currencies have cash flows, all sorts of things do. But alternative assets, which are commodities, of which gold is the king of commodities, it's the least volatile and by far the most liquid in financial sense, and you can hold it in physical form. So it's ideal as an alternative asset to be held for the long term by central banks, family offices, private individuals, and so forth.
Okay, let's go back briefly to this bit that you mentioned earlier about this idea that the Federal Reserve is planning to revalue the gold that it holds and how that might affect the price of gold. There's a lot of talk about this, as you say, it's on Twitter, therefore it's got to be true. Jack, do you know anything about this story? Because it rather seems to me that if you can change the price at which you hold the gold, but that doesn't make any difference to the demand for gold.
I think Charlie would be better at answering that, to be honest.
I mean, I'll do my best here, but it's speculation.
Of course, it's all
Let's start with
speculation,
that.
but we like a bit of speculation. And everyone's on Twitter, right? Or most of our listeners, I think, are on Twitter. They're hearing this. What does it mean for the US to revalue its gold reserves, which I think are currently on at $42 an ounce, right?
My defence for speculation, Your Honour, was Merryn told me to do it. So here we go.
Go, Charlie.
$42. So the US gold reserves, the best of my understanding, are in the books at $42, and which is a strange old thing. But that's really just a historic thing. It's probably legally complex to change it because it all relates back to the fix, where all the currencies were pegged to the price of gold for a long period of time. We don't need to go into history, so we'll just sort of spring it forward. What would happen if you revalued it to there's a spot price, and they're also talking about 4,000. I don't really understand why you'd choose 4,000. That bit was lost on me. But I'm told that if you, it's a sort of counting quirk, that if you did revalue gold to a much higher price, then that benefit would be shown up in the Treasury General Account, the TGA, and that's something that the US Treasurer can have some fun with to prop up asset markets. And certainly that's what the Biden administration were doing. And so, you just need juice to keep stock markets and financial markets in general going, plenty of liquidity and this sort of thing. So there is a feeling out there that might happen. But as I say, I just want to reiterate this point. No one's mentioned gold from the US government for 50 years, and now they're talking about it. And I think just talking about it is worth about $1,000 an ounce.
Well, I think that they're talking about it, and this business in China of insurers being allowed to buy it, for example, this change in the tone of the conversation about the extent to which gold should be used as an asset class.
Yes, the world's most liquid alternative asset class.
The only thing I would say, Charlie, is that let's say, for example, that gold reserves are revalued, say, from $42 to, let's pretend $4,000 or $3,000, wherever we're lucky enough to get to. That in turn, I read on Twitter, would effectively slash US debt, right? But if the US has a lower debt, then doesn't the demand for gold fall if it's an everything hedge and suddenly we manage to magic away a large chunk of US debt?
Well, let's not forget US debt's $36 trillion, so I keep getting excited by saying Jack Ryan.
Okay, I guess,
but as Jack was saying,
it's lots and lots of trillions, I'll give you that. But if for every $4,000 revaluation of the price of gold, you get to take $1 trillion off, makes it different.
Yeah, okay, it makes a little difference, 3%.
I think a bigger risk to gold, well, it's highly unlikely, at least in the short term. But you have these developed economy central banks who have huge stashes of gold. So the US has more than 8,000 tons. Germany has more than 3,000 tons. Those are the two big holders. And then even the Swiss and the UK, who sold some, they still have a lot compared to some of these large, growing, emerging market economies like China, India, Turkey. And so one of the risks to gold could be if you got to a situation where some of those developed economy central banks look at the gold price and start thinking we should start paring down our holdings, we should sell into this. And that kind of selling, which was obviously what characterized the 1990s up until 1999 effectively, that would be very bearish for the gold price. But there's no indication that that's going to happen. But that's kind of one of those small tail risks, just to prevent this from becoming the Gold Bug podcast.
I'd just like to say that Jack has misunderstood the podcast. It is the Gold Bug podcast. So we'll have no more of that negativity. Thanks very much.
You can edit that out. Cut it out after.
We'll be editing it out. No, we won't. Not really. Charlie?
I think the biggest risk to the gold price is all the governments balance the books. and start to repay national debt. So that is a huge risk, but not in the next 10 years.
I'm surprised you said 10. I would have said not, but rather longer than that. Anyway, right. So let's go back to what are the drivers. Jack, what do you expect to be the main driver of the gold price going forward? Because obviously you're fully on board with 3,000 soon, then 4,000, 5,000, right?
Yeah. Well, I mean, often it's periods of extreme instability create price spikes that then sometimes are maintained. So, for example, gold broke $1,000 an ounce in 2009 in the wake of the financial crisis. It broke $2,000 an ounce in 2020 during the outbreak of COVID. So in what situation will it break $3,000 an ounce? It might be Trump instability and fears about tariffs and what they might mean for global growth, for inflation, and then gold's appeal as a hedge against those things. I think in the longer run, I think central bank buying may well be a more important driver of the price.
Okay. Charlie, what do you think the big drivers will be over the next, for the short term, should we say, short to medium term?
Well, I mean, using simple round numbers, the world's asset base, which is stocks, bonds, real estate in the main, and a few other wacky things, that would be about $500 trillion. The value of all the gold in the world's probably something like $20 trillion. And so you've got to wonder what the weighting should be of all the gold in the world. And if you look at things like the private wealth industry, they're massively underweight. You know, when I talk to my old friends in that industry, which I came from, most of them say, well, they still own a bit of gold, but that all the youngsters in the offices managing other people's money don't. And so it's become far less popular. It's been more with investors generally. So I think that is a change that's happened. That there's and the main reason for that, as I wrote about recently actually, is because there's so much faith in the stock market. So investors tend to buy gold when they're worried that the stock market's going to go wrong, or they know it's going wrong. Certainly in the 2000-2002 dot-com bear market era, gold did very well, and it did pretty well over the credit crisis era as well, notwithstanding a dollar spike. Certainly was up in sterling and euros. And so, financial investors, when the stock market's not working, they're happy to buy gold. But because we've had so much fun with big tech in the last few years, that they really haven't put it to the fore.
Yeah, so the financial industry as a whole is massively underweight. Okay, so that's gold. Silver, Charlie.
Silver's fascinating. I mean, if you go back 30 years, the return of silver and the return of gold are basically the same. There's very, very little in it. And you would normally say that in the same way that if you think the stock market's going up, your tech stocks would outperform your defensive stocks. It's a pretty reasonable thing to say. You expect your silver to do much better than your gold. And so in 2011, we had a big high. We had some other silver spikes over the years. And right now, silver is really cheap relative to gold. You'd expect it to be at least twice as good as gold in a bull market. So the fact that they've done the same thing over the last 30 years, I would think that silver has the potential to do 2 to 3 times better than gold over any reasonable period of time, so long as this bull market continues. That's the historic relationship. And there's been very little interest in silver. The ETFs have been sold. The amount of silver held by the global silver ETFs goes down. The silver miners aren't playing. And so once again, we've got this audience that would have been there in 2010-11. Don't know where they went. They're not back.
So let's talk briefly then about the miners, because you would expect, wouldn't you, generally speaking, when the gold price and the silver price rise, the gold price particularly in this case, the gold miners to massively outperform. But that hasn't quite happened, has it?
Yeah, it's a very, very similar argument. Not quite the same thing. One difference between silver and the gold miners is that the gold miners have operating businesses, whereas an ounce of silver doesn't. And in a silver mine or a gold mine, probably 1/3 of your costs approximately are energy. So the price of oil matters a great deal. So for profitability of a gold miner, the spread between gold and oil matters quite a great deal. And so that really is on side for them. But I think that what you've got to expect over the next year is if you look at the free cash flow of the mining sector, you can put it forward 1 year and make assumptions about where we'll be this time next year. And it's quite clear to me that the margins at these prices of low oil and high gold silver, particularly gold, then the margins of these miners is going to improve quite markedly. And I think so much trading these days is algorithmic and database that maybe they're just waiting to see the whites of their eyes. And the miners, of course, have been hugely disappointing over long periods of time. Because it's a difficult industry, digging huge holes in the ground with huge machines and tires as tall as your house. This is tough stuff.
It is tough stuff. But once you've got the hole dug, you've paid most of the cost, right? So the operational leverage should be pretty high.
One hopes.
One hopes. And we used to always say that the gold miners in particular were horribly run. So, you can never rely on that happening. But they appear to be better run now.
Certainly the things like their ESG, which is not at the forefront of my financial analysis, but it's certainly a good indicator of that people are doing the right thing and doing things thoroughly. That seems to have improved enormously over the years. I think there are always going to be geopolitical issues about where you do business. So some of the mines in Mali haven't worked out too well. But if you're sticking to Canada, America, Mexico, Australia, and so forth, or even Egypt, the profits are coming through. I just think the stock market's being just not that interested in the moment in anything to do with commodities.
Yeah, but
more generally.
Yeah. So if the industry as a whole is missing a trick, perhaps an opportunity for our ordinary investors, right?
I would think so.
Okay, so how can our ordinary investors invest in the gold market and in the silver market? Jack, Charlie, who wants to take that one?
I'll let Charlie take that. He's the expert on that.
The expert. That's a terrible word, isn't it?
Definitely the expert.
Yeah. So, I mean, we're talking to British citizens, I assume, or we're talking to people all over the world. But if you're a British citizen and you want to invest in gold, why not treat yourself to a Sovereign or a Britannia, a real piece of metal, which you can buy in Sharps Pixley at the top of St James's Street or in one of these reputable online firms. Don't ask me which ones are reputable, but so then just go to Sharps Pixley then. But if you...
Oh, Charlie, I have to say, Dubai Airport. I was just back from Dubai and I was impressed by how much gold you can buy at the airport. You can buy pretty much any size of ingot you like and take it away with you.
And you can get the Sovereigns, can you? And the Britannias?
No, I don't think you can actually, just little ingots.
Of course, you could buy them from the Royal Mint. Silly me, I should have said that. But the reason you do that is because it's capital gains tax free until Rachel Reeves changed the capital gains tax rules. So maybe that doesn't last forever, but it's certainly true at the moment. But what I tell my clients at ByteTree is to buy the ETF, and there's one by iShares, one by Wisdom Tree. There are plenty of them these days. You don't have to pay much. Very simple way to do that through your SIP or ISA or your broking account. You can do the same with a silver ETF. Make sure you buy a UK or a European one because you can't buy the American ones because American ETFs basically were not designed for UK investors from a tax perspective and so forth. Your broker will probably prevent you anyway. And then if you want the gold mining ETFs, there's one called GDX. The ticker's GDX. That's the Van Eck gold mine. And then you've got the junior GDXJ, which is a little bit more volatile, but a little bit saucier. The junior miners ought to do better in a bull market. But all of these things, gold is fine. It's a very low risk, or not low risk, but low to medium risk long-term asset. Silver is probably a medium risk asset, and the miners in a basket of miners would be a medium high risk asset, I would say. An individual miner with not making any money, of course, would be ultra high risk. So bear that in mind. You buy a basket of these things, so you have diversified a large point of your risk. And as I said to Merryn earlier, that the worst thing that could happen to gold is really highly powered, credible, competent, economically well-educated chancellors of the exchequer. So if we have those, then the gold price is in trouble.
Yeah, who's worried?
I heard there was a great trick back in the 80s in the city, and Charlie probably knows more about this, whereby you could be paid a gold sovereign whereby its nominal value was way below its real value, and so you could be paid basically in a very tax efficient way. If you receive a £1 gold sovereign that's actually worth £500 or something like that.
Well, in the 80s, I hate to disappoint you, I was actually at school. I wasn't not that old yet. But I did hear that some of the tax wheezes back in the day was to pay people in the city with pork contracts. pork bellies like in trading places, and say you got paid in pork belly contracts, futures contracts, you'd have to pay tax. But I'm not sure if that lasted long or if many people took it up.
Bit inconvenient, yes.
Well, there were all sorts of things. I mean, this is something we're going off topic, but it's definitely something that, those who set income tax rates in the UK and Scotland might want to look at, how quickly and easily people in the 70s in particular found ways to avoid the high rates of income tax. And obviously lots of those ways have been taken away now, but I've heard about a lot of them. Probably shouldn't repeat them here, or I don't want to get anyone into trouble at this point. Is there anything else that we should say about gold? Or silver?
Yeah, I would say the final point, just to reiterate the fact that I think I started out this way, which I think the global financial system, whether that's private wealth or whether that's institutional wealth, or whether it's Western central banks, I think they're just structurally underweight an asset that's become increasingly relevant again in today's world.
Okay, so young people, take a look at your Bitcoin holdings. I said we were going to get to the end without mentioning Bitcoin, but I have just mentioned it. Take a look at your Bitcoin holdings and wonder if maybe you should diversify into a little gold. Jack, you're young. Have you got Bitcoin?
I don't. I think I'd rather go for gold ahead of Bitcoin. Actually, to pick up on one of Charlie's points earlier, the fact that gold isn't attached to an income stream, doesn't have a counterparty, it's trustless, in inverted commas, similar to the kind of intellectual case for Bitcoin. So in many ways, they are similar. And the fact that it's not attached to an income stream in the same way as other investments like bonds or stocks, it's either a very exciting thing or a very worrying thing, because the price may go as high or as low as anyone else is willing to pay for it. And it's not anchored by that kind of income stream. Yes, you can have some sort of supply response eventually if the gold price gets super high and people come back to pawn shops and trade in their gold. But it takes a long time to build a mine, and it could get very high in the meantime, in the interim. So that, I think, is, depending on your perspective, very exciting or very worrying about those two assets.
Okay, and now we have a new gold bug at Bloomberg. Welcome, Jack. Thanks for listening to this week's Merryn Talks Money. If you like us, show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Skathak. You on Twitter, Jack?
I am not.
Charlie?
Yes, my handle is Atlas, as in map, and Pulse, as in blood around your wrist.
Perfect. This episode was hosted by me, Merryn Somerset Webb. The show is produced by Summer Sadi and Moses Andam, sound design by Blake Maples, and obviously very special thanks to Charlie Morris and to Jack Ryan.